Okay, so we can think of market price structure as the way price evolves, and that's very simple. The normal market structure has these characteristics. So a healthy, robust market structure is liquid, which means that there's a large volume of exchanges. There's a deep book, which means that there is rich demand and offer at all price levels, and the spread is small. So the spread may be 1 pip, 2 pips between bid and ask. So when the markets are healthy and robust and normal markets, the liquidity providers are rewarded. And I'm going to explain you who are these liquidity providers. Right. So those are people like me and you when we trade on the small time frame. I'm going to show you in detail. And but a more formal definition is that these are the traders on a time frame that take the other side of the trade made in the direction of the prevalent trend on the time frame just higher. And I'm going to show you this in an example. So this is the most important point to understand. If in a market liquidity providers are not rewarded, then the market becomes unstable. And events like the May 2010 flash crash take place. So if you don't know what the flash crash is, just research on Google and read a little bit about it. I was that day. I was not trading, but it was unbelievable. With the SP 500 losing 9% in a few hours. So give a look at that, and so let me show you an example in the next slide. So what you see on the right side here is a healthy market structure. Now, the style of price structure that I do is based mainly on the work of Joe Di Napoli. I believe Joe is one of the few practitioners who really understood the far-reaching effect of HFT on price. And he really got the picture. And so the black lines that you see in this picture here is let's say the larger time frame, let's say 4 hours. Okay, the blue broken line represents the price action in the time frame just below, and I would say that this is the 15 minutes. Okay, so now let's assume that a trend follower on the 4-hour chart was capable of buying a retracement into and just got into a T1 into a. Let me see if I can annotate without creating any problem. So the larger time frame trader enters here. Now let's assume now that traders on the smaller time frame try to pick a short at a primus here, which is this T2 here. And what happens is that, of course, the timing of these guys is not perfect, and what happens is that they tend to pick up top. But what happens is that the market continues going higher, so they're showing a loss. These traders are the liquidity provider. Why? Because they allow the trader on the larger time frame, which is this black line here, to keep buying in the direction of the trend while the price moves from A to B. Okay, so these guys are the liquidity providers. Now, what happens if the liquidity providers miss meetings? If they miss the timing here. It happens that the market goes a little bit higher, but then it corrects. And as you can see, if let me clean this. If these guys who bought here do not sell above a primus here, but they wait, they can always actually with a gain. So they are rewarded, as I told you before, for providing liquidity to the larger, those who operate in the larger time frame. I hope this is clear. It's a very simple concept indeed. So this is what a healthy market is, a healthy price structure is. Now on the left side, let's look at what happens when high frequency trading is active on the market. So now what happens is that these guys here, they're buying, but what happens is that, look at this, the market does not retrace. And when high frequency trading is in the market, actually that's exactly the effect. So, and as you can see here, there is not really a lot of opportunity for the guys who enter here to exit with a gain. They always exit with a loss. Even if the market, the provider, the liquidity provider leave the market because they're losing money. And what happens is that this creates condition for the markets to moving higher without retracement, because now there are no guys who are selling here in high times to the traders on the larger time frame. So this is very important, and high frequency trading acts as a liquidity provider in normal market conditions. But however, when because high frequency trading is not regulated, what happens is that they disappear at the very right moment they need it the most, and defenders of high frequency trading make it lose his or her partner when he or she loses the job, exactly when the significant other is needed the most. So that's exactly, to make a parallel, that's exactly what happens. So I hope this gives you a little bit of perspective of why you should avoid trading on the smaller time frame and what's the effect of high frequency trading on our markets. Are there any questions on this? Very quickly. Take over trading. Well, there is a chance, and there is a big, there are new trends in trading. I believe there are some elements of trading that until there will be a participant, a portion of human participants that will still stay in the market. But basically, the algorithms have already taken over the market. So, and the market still respects some rules. And as I'll show you later on, is still in the second part, especially algorithmic trading somehow incorporate the psychology of trading. So. We have a chance anyway. So that's the answer to your question, madam. And is the 15-minute chart stop hunt 1 minute chart and 1 hour or 4 hour stop hunt 15 minutes? That's correct, exactly. You can see that. You can see that every time frame has their liquidity provider. The only time frame that does not have liquidity provider is 1 minute of the tick chart, because below that time frame there is nothing. Okay, good stuff. So let's continue. Thanks a lot for your question. I really appreciate it. So let's continue then. So this is an example of an healthy price structure, of course, as you now understand. So do we have to say a lot about this? If you're a fan of technical analysis, I have to disappoint you. I'm very, very sorry to disappoint you. So however you slice and dice it, technical analysis will not make you successful. And that's my opinion, of course. You might be you may be a different opinion. I respect that. I think it's very difficult to be actually now successful with technical analysis. So